Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. In this course, we will be discussing trading bonds. Now, there is, of course, inherent risk when deciding to trade the financial markets. So just before we begin, please do take a moment to familiarize yourself with the following disclaimer. So the main objective of this particular webinar is to discuss bonds, their issuance, the relation with governments, and we'll have a look at the yield curve in terms of defining interest rates and how they affect pricing bonds, so we can actually look to trade their price and profit in the markets. With the course webinar outline here, we have a quick description and discussion with an introduction to bonds. We'll then discuss the difference between stock markets and bond markets and the relation to risk premia. And then we'll be delving in more detail to looking at bond prices and how they're priced in terms of interest rates. We'll be also discussing bond issuance both at a corporate and government level, and then finally discussing the yield curve, which basically depicts interest rates as an issuance of bonds over time. So with our introduction to bonds, a bond is essentially a way for a company or government to raise capital to meet their financial obligations or to finance projects. An investor can participate in lending to the institution with the objective of making a return from investment, and this return is known as the coupon. The coupon is basically the set premium to actually investing in a bond that will tell you how much money you're going to make over the life or duration of that bond. Perhaps it could be paid out semi-annually, annually, or perhaps quarterly on the coupon. The issuer of the bond will effectively sell debt to the financial markets, creating new financial liabilities on the balance sheet in exchange for fresh capital. So basically, they're issuing debt to the markets, hoping that investors will pick up this debt and replace that with fresh money so that they can continue and invest in the markets. The level of interest investors will receive is a function of perceived risk, and that risk is really an example of the possibility of default and the time of maturity. So if you think of a bond basically as an IOU, you're lending perhaps 100 euros to a friend. Obviously, the duration of that loan will depict how much interest you'll actually want from lending that money. And obviously, then the possibility that your friend may not pay you back over that period of time will represent formulating how much money you're going to lend, and as a result, how much risk is involved in that loan or the trade. Corporate bonds are a good alternative for firms that want to raise capital without diluting or reducing their percentage ownership of the company through selling equity, and i.e. that's new share issuance. And we'll look at that in some detail here when we discuss actual corporate bonds in the equity market as well. It has a very, very tight relationship in global investment. So in terms of discussing how companies raise capital, in what ways can they do this? Well, companies can do this by, one, borrowing, and that's by debt. So basically the selling shares of itself and essentially allowing others to become partial owners. That's equity. So one way is obviously to sell a portion of equity or ownership of a company, hoping that investors buy that, invest in your company, but they actually become a part of that company. Or you could look to raise capital by selling bonds or issuing bonds, and that's by effectively looking to borrow from investors. We call both of these instruments financial securities. A security in the debt world is a bond, and a security in the equity world is, of course, a stock or a share in a company. So let's delve into a little detail discussing these two different asset classes, stocks and bonds. Since when discussing stocks, since each share of stock represents an ownership stake in a company, meaning the owner's shares in the profit and losses of that company. So obviously, if you're owning a part of Google, the change in share price as it fluctuates and increases and decreases, that will affect your overall value of your own sharing or owning of that company. Someone who invests in the stock can benefit if the company performs very well and its value increases over time, and at the same time assuming the risk that the company could perform poorly and the stock could go down, the person or investor will lose during that that time period. Individual stocks in the overall stock market tend to be on the riskier end of the investment spectrum in terms of their volatility and the risk that the investor could lose money in the shorter term. However, they also tend to provide superior long term returns. Stocks are therefore favored by those with a long term investment horizon and a tolerance for short term risk. And that's very much uh, in contradiction or in contrary to the bond markets where the risk is really short term money and the possible default in the short term. Um, Bonds lack the powerful long term return potential of stocks, but they are preferred by investors for whom income is a priority. Given they are instruments of debt, they are less risky than stocks. Okay, and that's again fairly self explanatory if you're investing in the bond markets, and there's a very low level of interest in that particular bond. It's going to give you not a very high level of return, but it's going to give you some income if you do invest in the bond, as opposed to investing short term in risky stocks. You can often see their prices rise quite quickly. While their prices fluctuate in the market, sometimes quite substantially, in the case of regional risk, the vast majority of bonds tend to pay back the full amount of principal at maturity, and there is much less risk of loss than there is with stocks. So again, if we maybe move away from corporate stocks and think of, corporate bonds and think of government bonds, there is less risk if you're perhaps deciding to purchase a 2 year government bond. There's less risk that the government will not be able to pay that bond at maturity after 2 years. It is, of course, the government after all, and you do have a level of confidence that they'll be able to pay back their liabilities. Government debt markets are of particular importance to fiscal policy and in running the economy. Traditionally, they are regarded as the safest long term investment, as the government is, of course, considered to be a very likely partner to repay the loan of its creditors. More recently, and if we discuss, which we will do later on in the webinar, the European sovereign debt crisis, heightened levels of default risk as a consequence of potentially financial crises has forced the markets to reprice many of these assets entirely. So let's discuss bond pricing in relation to interest rates. So here with this example, we have a 1000 US Treasury bond. It has a 5 year maturity and a 5% coupon. So that will reflect the level of risk in terms of an interest rate, that 5% coupon. And the bond has dictated that it will pay annual repayments. So what we're looking at here is a 5 year bond. The principal is $100,000 and with an interest rate of 5%, and that's going to be paid each and every year. So on issuance, the price of the bond reflects the level of risk and hence the interest rate at that time. So whatever is going on in the economy and within the financial sector, all of these market participants and investors have viewed an assumption with a level of risk to actually price this bond. That level of risk is the interest rate payment at 5%. As we go through in each individual year, we have, of course, our interest rate payment as an annual coupon. So 5% from our $100,000 US Treasury bond is, of course, 5% per year, and we get that each individual year until we get to obviously the fifth year, as it is a 5 year bond. We get our 5,000 last coupon payment, as well as the full principal, which is $100,000 back from the bond. So effectively, you can see the layout of the loan. It was a 5 year loan with the interest paid through annual payments and then the principal paid at the end. So 5% is, of course, a good interest rate for the level of risk at the time of issuance. The question I would like to pose is, what would happen if an event then caused an increased level of risk in investing in US Treasury bonds? So perhaps we have something significant. We have changes in the US dollar. We have maybe some crises affecting the banking industry or the commodity sectors, something rather significant that may actually cause some fear sentiment entering the markets. How would this actually look to reprice interest rates and obviously reprice the bond? So if that event occurs, let's take this example. We'll use the same bond structure, a US Treasury bond of $100,000. This time we have a 10% coupon. Interest rates go up to reflect our 10% coupon here. So that level of risk has actually increased the interest rates on lending. The market now offers a higher interest rate for the same 5-year bond. So this new event could potentially have happened 1 month into our previous bond at 5%. And obviously those new changes in fear or uncertainty in the markets will reflect the bond price and interest rates. So interest rates in this example have went up. The market has now repriced interest rates with the same 5-year bond. What we can see is the same level of pricing in terms of annual repayments. We see the 10% coupon actually paid out on annual repayments, and that equates to obviously 10,000 on our initial payment of the 5-year bond of $100,000. We then receive the principal at the end. The previous 5% coupon bond is now not as valuable in the market, as the market now offers 10% coupon for the same 5-year bond, a $100,000 bond. The bond is trading at a discount to par in this example. So we have, to summarize, two bonds. They're both of the same maturity, both with the same government, and the US government, of course, the Federal Reserve, issuing the same 5-year bond at a full payment of $100,000. Which bond would you prefer to invest in? Of course, the one that pays the 5% or the one that pays the 10% coupon rate. Of course, it will be the 10% interest rate, because you're able to make more from investing in the US government bond over that 5-year period. Because on issuance of the 5-year bond, the initial 5-year bond at 5% coupon cannot actually be changed. The bond markets will have to actually reprice the bond in terms of its price in relation to the yield to actually make it more sellable in the markets, and that's exactly what happens. So let's refer to our initial US government treasury bond, a 5-year bond at $100,000. Again, it has a 5% coupon with annual repayments. When interest rates go up, investors expect more return from the bond. The bond isn't able to give more returns, so the price will go down to reflect this. Okay, so that's what we see in the markets: interest rates rising and the price of the bond going down to reflect these free market movements. Likewise, when the interest rates go down, the bond is giving more than people's expectations are, and so investors are willing to move to purchase these bonds, and therefore the price will rise. Again, as the price of the bond decreases, the interest rates will rise. So let's discuss bond issuance with Company A, perhaps a US company that has $10 million of assets. All of these assets are out there in the free market as equity. So if you're an equity investor and you want to own part of this company, you could look to purchase some of these shares to be an investor in this company, and obviously have some level or degree of ownership of Company A. Likewise, if Company A is looking for a $2 million expansion, perhaps it's looking for some capital of $2 million, it might choose to actually go into the equity markets to sell $2 million worth of equity so that they can get that capital for expansion. Another way that they can do it is, of course, through bond issuance. So let's debate what this may look like. They choose or opt for a $2 million expansion with debt issue. So they go into the bond markets. Company A issues 200 bonds at face value of $10,000. Company A decides on a maturity of 2 years, and we can see the trend line there with their issuance date, year 1 and year 2. Issuance has a 5% annual coupon, so the company is looking to sponsor this debt with an interest rate of 5%. Investors therefore look to the markets and look to buy these bonds, essentially lending to Company A. The annual coupon at 5% pays $500 annually, and the bonds expire on maturity. Company A pays back the bond principal with the last coupon on year 2. So the issuance of government bonds is really no different than corporate bonds. They're looking to fulfill their borrowing requirements, whether they're looking to expand or perhaps do some domestic investment. Governments must borrow to run national affairs. In effect, governments sell or issue government debt over a fixed term. So more commonly, in relation to government bonds, we see 2-year bonds, 5-year bonds, 10-year bonds, and 30-year bonds in the debt markets. Bonds are auctioned at market to determine price, but many large financial institutions commit to bond purchase programs pre-auction. The price reflects the economic outlook and stability of each region as a function of perceived risk. When there is greater risk and more uncertainty that a region will not be able to repay its debt, the market will demand a much higher rate of return, i.e., the yield on the debt issuance. So when we decide to look at the bond markets or debt markets to actually price these bonds, we have to think of how each individual investor will look with their assumption of their own risk. Perhaps there are many investors that are looking for greater returns and potentially are looking for companies to issue debt at a higher level of risk, and obviously that will be reflected in the yield. And obviously many of those other investors who are looking to diversify their portfolio, perhaps they're more focused on general income as opposed to taking higher risks. So the market demands a much higher rate of return or interest rate on these government bonds. And if you think of the market participants and the investing community, how they have different um, approaches to appetite and investing themselves, some investors will look to actually take on more of a risk approach and potentially invest in these higher interest rate bonds. Here in this example, we can see the European sovereign debt crisis with long-term interest rates. And we can see that Greece had at one stage a 27% interest rate on their bond. So a fantastic level of return, but we know that there was a huge level of risk in actually investing in Greece and euro denominated assets at that time. On the flip side, there are, of course, other investors who want to diversify their portfolio and are more focused on gaining a level of income from bonds. Perhaps in this example, they would look to invest in countries here on the map. We can see Austria, Netherlands that are offering in and around 3 to 4% interest rate for their long-term bonds. So it is a question of what type of risk you would like to assume as an investor and how the investment community looks at this reflected risk to actually price these assets in relation to the interest rate and obviously their price on the bond side. When discussing the European sovereign debt crisis, we really understand 3 to 4 countries that really had a lot of problems at the time. And that was, again, when we discussed government bonds, that was reflected in their interest rate levels. So I have mentioned Greece there. We had also Ireland. We can see the chart. Ireland, Greece, Spain, Portugal have very high interest rate levels over that period of time. And that would be reflected in their bond markets, them as countries issuing their bond markets to the open free markets and actually looking to offer higher levels of return in investing for their bonds to attract investors in investing in their assets. So when pricing bond markets in relation to government bonds, of course, it is the free market operations that look to price these bond markets. And there is two main factors that price the bonds, the perception of risk and of course the time duration that you look to actually loan or purchase an issuance of one of these bonds in the financial sector from the governments. And that is how a lot of these financial institutions and large investors look to price these bonds in both buying and selling these bonds in open market activities. What we'll do here is look to plot the yield curve over a long duration of time. So first and foremost, when we discuss these bonds, you often hear, particularly in the US, we discuss treasury bills. That is simply the relation to short-term money in the markets. So that means lending money for a period of 1 month, 3 months, 6 months, or 1 year. Then we discuss treasury notes. Treasury notes are anything from 1 year to 10 years within the market, and then treasury bonds, which is our longer dated bonds, more significantly 10 years to 30 years and even over at times. So what we'll do is, if we think, is just to plot the yield curve again to bring it back to a revelation of actually loaning some money or an IOU to a friend. And the risk is, of course, the time or the duration, whether it's going to be 1 month, 1 year, or 10 years, you're loaning your money to a friend, and obviously the level of risk there is during those periods of time to reflect the interest that your friend is offering you for this amount of money. So we're going to look at our table here and simply plot the points where we have our interest rate. We'll actually choose this one. These are separate dates here, and we'll choose this marker at the bottom. Our 1 month 1.68 interest rate level, and this is of course annualized. So for all of these figures, it is broken down to an annualized percentage. And then we'll go to the 6 months. We'll look at the 1 year. We'll look at 5-year debt markets. And we'll look at the 10-year bond and finish off with the 30 bond. So let us look at plotting those points on our actual yield curve platform here. The first point plotted on our yield curve there is in relation to short-term money markets, and it's again looking to lend money from the US government there for a 1 month period. It's quoted as 1.68, so we've plotted the point there at 1.68. And I would like to note that this is actually not reflective of lending money and earning 1.68% interest on that 1 month. It is, of course, an annualized figure. Then we'll plot the point there with our 6 month short-term money market interest rate at 1.91. Moving on to our 1 year T-bill of 2.06. The 5-year Treasury note there at 2.58%. The 10-year Treasury note or T-bill is at 2.77%. We've plotted again the 20-year at 2.89, and then the final 30-year bond at 3.01% interest rate annualized. So when we actually connect the dots and look to plot our yield curve, we can see that it takes this upward forming structure, and that reflects that loaning money over different periods of time will reflect obviously the risk involved in the duration of each bond relative to the risk in each economy, and that's how global government bonds are actually priced. So that brings us to the end of this review on trading bonds. We discussed obviously the introduction to bonds as a relation with risk premia to stock markets. We looked at the real link between bond pricing and interest rates and how that they're effectively inversely correlated. When bond prices move up, interest rates will move down. And of course, when interest rates move up, bond prices will move down to reflect that new issuance. We discussed the bond issuance from both a corporate and a government level, and then discussed how market participants look to trade both buying and selling in these bond markets on auction and in the secondary market to assess the yield curve. And it's really a perception of risk at any given point in time in relation to the duration of each individual bond. So that finishes off this lesson discussing bonds. Thank you very much for joining us on this installment of Course on Demand by Forex.Academy. We do hope to see you very soon. Bye for now.